This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing podcast. This is podcast number 100, the centenary, the one that people think and thought would never happen. This is the 100th podcast. So with my co-host, Wheelie Dealer, we all say, cheers, everybody!
Cheers, everybody!
Cheers.
Cheers.
Congrats!
Okay. Thank you very much, guys, for joining us. We have some special people in the room today. And let me just give some people a shout out. We've got Jason at Stealth Serve. We've got Elric at Lemming Investor. We've got Michael T. We've got James James. We've got Don't Tell 'em Pike, Sell Options. We've got Every Day's a School Day. Got so many people to thank for us even getting here. And we've had loads of very, very special guests. So I'm going to ask all the people that have joined me today to just put their videos on mute and audio on mute and the videos off. And I'm going to talk about the markets as we get along. So, Wheelie, we have got to thank some people for getting us here initially, have we not?
Oh yeah, absolutely. Mate, I've got to thank you because your work on producing the podcast, your organization beforehand that people don't see has been absolutely amazing. So thank you very much for all you've done. It's been awesome.
That's very, very kind of you, mate. I must say my back is absolutely killing me from carrying you from November 2018. But
mate,
couldn't be here. Couldn't and wouldn't be here without you, Pete. So here we are.
I was thinking about this earlier today, right? With 100 podcasts done, we've been pretty much been going 4 years. Now I've been struggling with my health for well over 2 years, and you've really carried me through that. So I really appreciate it, and thanks.
It's good, mate. It's not just about the podcast. It's about the fact that we've bonded, we've grown, we have our little, you know what I mean? And you can pick the phone up at any time to give me a call when you're not feeling great. So that's what it's for. That's what friends do for each other.
Exactly.
You know what I mean? Right. So let me talk about some of the other people that Pete and I have got to thank for getting us here. First and foremost, I want to give a really, really big shout out to Pete. Obviously, we couldn't be here without him and what he's contributed to the show. I'm quite dry. I say what I say. Pete's bringing all the jokes, bringing all the banter. So that's why half the people listen, to the show. Secondly, getting a sponsor was an absolute landmark for me and for us. And getting SharePad on board was absolutely phenomenal. We had lots of conversations beforehand when we started about what we're going to do and how we're going to do it. And the main conversation I had with Pete back in, I think it was July 2018, before we started eventually in November 2018, was that this was going to be a podcast where we just talked about stocks and the realness of it, what was going on for us. No ramping of stocks, no BS about this, that, and the other. Just tell it as it is. And that's what we've continued to do. And I think that's why we've made it the way we've made it and continue to be here now. What are your thoughts, Pete? Because we've seen other podcasts go, haven't we?
I think that's the thing. I think it's we are both active private investors ourselves. And I think because of that, we bring a sort of realness to it and a sort of, we are embedded and immersed in this every day. And I think we bring that to the podcast. And I think that our listeners can relate to it on that level. And I think also the way we invest is a bit different. I'm definitely more conservative and more sort of cautious and more cautious and sort of measured with my investing. and less active, you definitely take a higher risk level than I would. And I think that brings different perspectives to things as well, which I think, again, adds to the realness. And it means that, you know, different listeners of different interests can find something useful from it.
Absolutely. I keep hearing that I take more risks, Pete, or I have a higher risk portfolio. And it's not true.
I think you do a mix. I think you do a lot of stuff in a similar way.
I do a mix. Yeah,
lot of stuff in a similar way to me, where it's buy and hold and it's long term. But you also do stuff that's a lot more exciting, and you're a lot better than me at actually selling things and moving on. That's something I'm not good at, and I definitely need to improve that.
Okie dokie. No worries. Right. I'm going to go back to thanking some people again now, Pete. First of all, some of our historical guests that we've had on. We've had some guests from Australia, or a guest from Australia, and one from America as well. So I want to mention Katerina at Katerina MTAUS, Seth Levine at Seth Levine 2, which Pete thought was linked to Maroon 5 at the time, I think, when we
had
Seth on. Vonnie Leah, she's based in Leicestershire. So thank you, Vonnie, for being previously on the show. We've got one of our previous guests on the show here on this show as well, Peter at Claudio H. Fox. We've got Elric at Lemming Investor, previous guest.
Yeah.
I think we've got Ben, although we may be here temporarily. Ben at Go Left Massa. One of our very first guests was Ryan at I'll Get You Gadget. On the show, we've got Michael T at Michael 51492851. We've got James at what? Sorry, I'll say it again. James at James N1.
Yeah.
And we haven't got Craig. We've had the secret accountant Craig. We've had Tim Rogers at Tim Rogers 1962. Jason Self-Serves on the show tonight, so brilliant. We've had brilliant again. Simon at Brilliant Leaders, a previous guest of ours. We've also had Bill Oakley and John Newman as well. So I want to thank everyone that's been on the show, and you've helped it make the show. And you've helped us progress from the echo chamber and the noise that was the SoundCloud platform that we first started on in November 2018, where it was just chaos. It's like just absolute rubbish. And you guys started with us and have stayed with us. And now we're at 100. We go back to something like May 28th, 2019, and we did our first mellow. And Pete Wheely and I were in a room of about 20 people, maybe 15 people.
Yeah.
And we had Dan Nandeel in that room. I think we had Michael T in that room as well. I'm not sure if I'm correct on that. I might be wrong. Yeah. But we had Ian Smith. Remember Ian, the guy that works on the rigs?
Yeah.
Ian was in the room as well. And that was our first live one. So everything seems to happen in May. And then in May 2020, that's when we got signed up by ShareScope as our sponsor. So we just keep evolving. And here we are in May 2023, and we're celebrating our 21st. Sorry, 21st, 100th episode. So yeah, all good.
I love the fact that we've got a load of people on the call tonight, and thank you for everyone who's come along and joined us, because it was something that me and Pete, before we even started the podcast, the first idea Pete had was to actually have this kind of setup with a load of people dialing in. And we've never tried it before. And we've sort of been forced into this because of my health situation, because we actually wanted to do a physical, real live event. And we were unable to do that because of my health. So we decided this was the next best option, if you like. So thank you to everyone who's come along for that. And I also want to say thank you to all our listeners who stuck with us all these years, because we are absolutely nothing without our listeners, and also our followers on Twitter, our readers of our website, people who watch my TikToks, people who listen to Investing Matters that Peter does, people who follow Pete's Twitter account, his website, blah, blah, blah. Thank you to all that, because that just inspires us so much.
Yeah, absolutely agree with you. I want to say one more thing before we go to our first guest. When we first recorded the very first Twin Peaks Investing podcast in November 2018, the FTSE 100 was sub 7,000. It was at thereabouts 6,980 when we first published our first podcast. Today, the FTSE closed at 7,773, just about 10% up, excluding dividends, right? So five years of compounded dividends will probably give you more than 10%, obviously. But yeah, this is where we are. So where the FTSE closed today, 773, down 97 points because of noise in America, down 1.24%. FTSE 250, minus 0.57%, down 100 points. FTSE All Share, down 1.12%, 48 points at 4,235. And the FTSE AIM All Share was down 0.21%, still above 828. So that's where we are. You know, what Pete and I have always tried to do was try to put together a podcast where we do not talk about our own shares all of the time. Yes, we talk about our shares occasionally, but we're trying to generate research ideas for other people to go away and discuss research themselves and possibly find ideas that they can actually profit from themselves. What I'm really pleased about is that I've always tried to project this position of paying it forward. I've learnt loads. Yeah, I made loads of mistakes. I'm still trying to learn. That's why I'm hanging out with people like one of our guests, Algy, to try and learn more from him because he's the brain box. And there's loads of other people. I met a recent guy down at the Master Investor Show called Jared Maloney, who's on the show tonight, learning from him because we've got a similar sort of experiences. But what I've always said to people is to always show some level of kindness. Don't go out of your way to be unkind. Try and be generous to other people. And this is what Pete and I have been trying to do for these 4 years. We know a little bit. Do we know it all? Absolutely not. So we try and learn from other people. And what we do learn and what mistakes we make, we try and give that and pay it forward to other people. What really, really cheers me up is when I see other people taking from Pete and I and then paying it forward to other people. I've got a fantastic example here from one of our followers. And I've got to read this out very early on because it really did move me. One of our followers, Richard Gatenby, at Gatson Jammer KI1, and he wrote this only a couple of weeks back. Peter and Peter, I know you don't give share tips, but on one of your podcasts, you spoke about Wood Group. I did my own diligence and bought in at £1.28. They're now at £2.25. This goes for the takeover. Thanks to you, I'm up 75%. I will pay it forward and give it to the backup and give some money to the backup trust and Memphis, my second takeover. I mean, what that's what we want. You know what I mean?
Fantastic.
Pay it forward. Thank you, Richard, for that.
That's brilliant.
Really, what do you want to say? We're going to have a guest on in a second.
Well, quick thing I want to say very fast. I don't know if we mentioned already, we're recording this on the evening of Tuesday, the 2nd of May, 2023. And the other thing I just want to say is thank you to all the people who've paid money to the charity causes we've been supporting, because we've done a lot with, well, we did the backup charity last year, and we've done Memphis, which we're doing this year, and we've done the year before.
Yeah.
A lot of people have paid a lot of money to that, and it's been brilliant. So thank you so much for that.
Absolutely spot on. I was going to mention that a bit later on, but I'll mention it now. Over the past nearly 3 years, betwixt the backup trust and Memphis, we have raised over £31,000, right? And that's gone to the backup trust and the Memphis charities. I must give a massive shout out here to Elric at Lemming Investor, because he helped me personally raise almost a third of that amount. I know I need to do the maths, but it's at least a third of that amount when we put an event on together at the Memphis hub in September 2021. So a big up to Elric there. And Pete and I have done, I think we did a live, we did a live event, 2 live events at Mellow as well. So this is what we keep doing. We keep evolving and doing different things. But those two charities have benefited because of the generosity of the audience that we've built over the past 4 years and the followers that we've built. And we wouldn't have been able to raise that without all of your help. So thank you ever so much for that.
Fantastic. Absolutely fantastic.
Cool. Right. I think it's time. We've been chundering around and bouncing around for a little while now. So thank you for persisting with us, guys, ladies and gents that are on the screen right now. I'm going to hand over now to Jason at StealthServe, and he's just going to give us a little talk as to how he finds some of his quality stocks. Over to you, Jason.
Have you got me? Yeah.
Yeah.
I can hear you good and clear, mate. Go for it.
Yeah. So, you know, I've just come at this blindly, really. I didn't know what to do tonight. So I just thought what I'd do is just run through a little bit of the market environment, how it compares with sort of past market environments we've had to navigate. And if I give a bit of an example of how I dealt with the post-pandemic, sort of finding the stocks in that sort of marketplace, it might help someone in sort of this market. So if that sounds all good.
Sounds great.
Go for it.
Just go for it. So do you want me to share a screen? Would it help?
Yeah, you've got co-hosting facilities, mate. So you can go straight to share a screen if you wish.
Oh, wow.
I'll just have to move something out of the way so I can see it. So you've got my sort of share scope screen up there.
Yes.
So basically, I'll just run through the markets first. Everyone who knows me will know I'm a long only sort of trend follower of small to mid cap growth stocks mainly. So that's what I'll focus on. Basically, you know, we've come into this correction bear market. You know, it's a bear market, isn't it? As we come into all bear markets, and I think we've sort of we've reached that sort of. I'll come at it another way. You know, when we're this far into a bear market, it's easy to really just get the negative thoughts in your head. And every bad market I've traded out of, it's been a wall of worry. You know, it climbs the wall of worry. Every wall of worry market is a fantastic market for growth stocks. So sort of where we are now, it feels to me like the 2011, because it was so volatile back then. It's actually more orderly than 2011, even though we've had more of a correction this time, more of a pullback. And you know, the 2009, you know, I got burnt a little bit here as well. And yeah, you know, it might go lower. It doesn't matter if it goes lower or not. You know, if it goes lower from here, well, the bigger the wall of worry we can ride in the next bull market. But basically, you know, let's just sort of go back to the pandemic. I've got the S&P up here, but it doesn't matter what market you bring up. And there's something what's easy to get. You see the market bounce off the lows, and you know, one thing I always say to sort of people who visit my chat room is just don't get the FOMO. The stocks will turn up. You know, I buy breakouts and I buy pullbacks in uptrends, and you know, the last 3 weeks has been pretty good in the area I do business. And you know, the likes of W7L and stocks like that, you know. So my job is to find the best growth stocks at this point in time, not the prior leaders from the last leg. You know, it's easy to get hung up on. I mean, as an example, you know, Fever Tree and Boo coming out of the pandemic, you know, those stocks were from the previous market, you know, and it's easy to sort of, you know, get that rear view mirror sort of it affects what you're seeing in front of you, I think. So the way I come at this, and I'll just run through a few stocks in this little market area here. The 250 is probably a good market to show it on. In fact, I've still got my charts still sort of marked up. This is where small caps started emerging in the UK, and it was well off the lows, you know, but we started to see good growth stocks break out. So what I'm looking for in this market environment is, you know, I'm looking for constructive price action, stocks what have kind of refused to go lower as the market's gone into the bear leg. So if we just jump back to what happened in the pandemic, I'll just jump onto a few of those stocks, and we'll just go the really obvious ones. And these were obvious before the pandemic. So this is what CER did. You know, it was trading sideways and it broke out. This is what we were looking at. And during the pandemic, it just came back in. It's remained in its uptrend. It was one of the best growth leaders I could find in the UK. And I didn't actually buy it until here. It went straight back to highs and I bought it on the pullback. But these are going to look, you know, the best stocks coming out of the bad market environment. I'm a growth investor. I like to ride trends, you know. They're going to be pretty obvious, and they're going to be in the top quarter of the screen, the right-hand quarter of the screen. So if I just jump through a few of these.
Jace, can I just make the point that what you were seeing on this CER chart was that you had a sideways range for quite a while, and then it did a breakout higher. And that's what you're really interested in, isn't it? Is that breakout?
That's my game, isn't it? Breakouts and pullbacks. So
yeah.
So, you know, it actually broke out here.
Yeah.
And it pulled in again. And,
yeah.
You know, some people will call that failed breakout. I don't, you know, I don't sort of trade that way. You know, I buy my position, I put my bracket on, and I let the trend play out. So I'm not trading around and trying to be too clever. I'm just trailing a stop. So, yeah, really obvious, you know, and this one just came back in, and it's one of the first ones to fire off. In the US, there was Zoom as well. You know, that was another one what refused to go down. It's as if these, you know, some stocks knew what was going to happen. But another one, you know this one well, Wheelie.
Oh yeah, too well.
Same. You know, sideways forever and a day.
Yeah.
I actually bought this here and added to it here. So you know, that's what I was looking at when I was buying this stock. You know, it was breaking out. This is 52-week highs.
Yeah.
So really obvious. Obviously, there was a little bit of a cheat in the right side of this base. Another growth leader. You know, if you screen for growth just after the pandemic and before the pandemic, all these stocks were on the growth leaders board, and they were there for months. Yeah.
What do you mean by, Jace, what do you mean by growth leaders? Do you mean ones that were showing sort of like the best 1 week highs, the best 3 week highs, whatever it was? Is that what you mean?
Well, I always say all the information is in the numbers. Yeah. I trade towards, you know, accelerating growth. I like to see growth breakouts, quarter on quarter, half on half, year on year, earnings per share, turnover.
Sorry, yeah, you're talking fundamental.
Yeah.
Okay, yeah, I'm with you.
So, you know, not stories of growth, actual growth. And these were real, any growth screen would have picked these up. So, you know, it's another one, really easy, really clean entry, lines in the sand, and off it went on its journey. You know, lovely trend, really obvious at the time. So the sort of emphasis here is on, you know, they might look a bit too obvious, but guess what? You know, we don't need to complicate this game. Ergo, another one. So this was a really good sort of move up here, and then this is what the pandemic did.
Yeah.
And same. You know, I bought it on this day here. I added to
you
it.
You bought it on the breakout, and up it went. Yeah.
Bought it on the breakout.
Yeah.
Added to it really early. Actually, it went sideways after it broke out for a week or so, and I added to it on this day.
Yeah.
So really simple. This was a screaming sort of, if you scream for growth leaders, growth breakouts, acceleration in growth, another one. It was there. It was a top 10.
Jason, something that you see on a lot of charts is this step thing. You mentioned step just there, didn't you?
Yeah,
it's like a staircase going up.
Yeah.
Yeah.
Not a great example in that one, is it? Because it kind of goes
off.
You can
see it in most of them, can't you? What's your take on Ergo in terms of the sideways range we're getting at the top now? Do you think that's still a sideways range, or is that showing signs of rolling over?
I think it's holding in there, isn't it? But
okay.
But yeah. I can see the tick up in growth as well. But I think sometimes you'll get a big sort of I'll just draw it on the chart. Sometimes it wants to get out of this congestion zone, and if it moved up here and then tightened up, this kind of price action, just a tightening base. If you was in the market sort of in late 2011, early 2012, you will see this all over the charts.
Yeah.
And even in liquid stocks, and you'll get it's the institutional sort of footprint as they accumulate. They can hold a stock in a range for as long as they want, and it takes them time to get the fill. When they get the fill, they can break them out. So I'd rather be seeing the better action, rather than just getting involved.
Yeah.
At this point.
So what you've drawn there is a higher low. Yeah.
Yeah.
Yeah. Well, it's interesting because I've noticed a similar pattern on GSK at the moment. I think that's doing the higher low and looks quite promising.
Well, there's a stock you've mentioned this week actually, and I'll jump onto it.
Yeah.
But these big efficient stocks here, they're more of a shorter term swing vehicle for me. If I was still sort of dollar cost averaging, they're the perfect vehicle for that, aren't they?
Yeah.
And for that sort of style, it's not about market timing either, is it? So much as just playing it out. But another really obvious one from back then, and this one's got a little bit of what I talk about. This was the pandemic, and this is the price action that followed. Just tightening price action. And I actually didn't buy it here; I bought it here. But really obvious. It's going to be, if it's easy to invent ideas, but these ideas are really obvious. And if you looked at the growth at the time, it was. I'll just bring a different chart up to sort of highlight that if it's possible. So this is just ShareScope. You can just add this on ShareScope if you put the log scale on, obviously. And what I'm sort of getting across here is failed breakouts, negative forward numbers, or the numbers might be positive and it just misses. And you've got a base here. This one just rolled over. Same negative forward numbers, and basically it just rolled over, didn't it again, or it missed.
Yeah.
And from here onwards, you've got positive growth, accelerating growth, and it made a fantastic run. But look at the growth tick up here. This is acceleration. When I say acceleration, I'm not talking about just a big number. I'm talking about it might have posted 20% on the last full year, and now it's a bigger number. So
it's 25% this time.
Exactly.
So is that a profit line? Those dots you've put, the blue line and the dots.
That's on. It's a share scope study, and it's just the full year earnings. Earnings per
right.
share.
Okay. Yeah.
It's not exactly in line with the numbers, the dates, but yeah, it kind of, that's what I'm sort of looking at. And guess what? Anything can hit the tape as we're riding these things. It is what it is.
Yeah.
But you can stack the odds in your favor by just picking off the ones what are actually trading towards the best growth, and also, I would say growth and guidance. If it's got great forward numbers and the guidance, an inline is better than an inline's fantastic if it's got fantastic forward numbers.
Jace, can I ask you a quick question here, mate? With regards to our second guest that we've got on here, is airing towards the highest quality of stocks. Could you show us a chart for one of the highest quality stocks that you've ran over the past year or so, which all of us should have recognized but probably didn't, please?
So obviously I'm a trend trader and I run a market model. So I've been in high cash since February. All these trends ran out of steam. So I'll just jump on I'll show you one. I'm in both of these, so I've totally cursed my own stocks here. But
oh, you've cursed mine as well now, mate.
I know. Sorry,
I bought these last week.
Sorry about that, but real obvious. I didn't get in it on the first base. Still managing my risk in a bear market, but I am in it now, and the game is breakouts and pullbacks. If you're a trend trader, breakout, pullback, breakout, pullback, high. So, feeding the winners, I've already added to this. At the moment, it's a volume lead. It's a growth leader for me. It's not right up there in my list, but I just trail the stop. If it beats, it will keep going. If it misses, it might go to sleep for a while. If it gets some kind of, it just the growth rolls over, it'll stop me out, and I will just, compound the return, move on to the next one.
Yep.
Cool.
Do you want me to?
We're going to call that example there. I'm just going to read out some of these questions I've got for you here, and one of them is from Richard Baxter. And Richard says, Richard is asking, what proportion of your trades win? Obvious question for most people. Well,
as a trend follower, over time, the more trades you take, it's going to end up around mean. So you're going to be in the 40% to 60% area. Because I'm out of the noise on these, I've got quite a good hit rate on these. But what I will add is, in a bad market environment, you will have strings of losers. In a good market environment, you will do very well. You have strings of winners. But the most important point is the win rate doesn't have any sort of, it's not what makes you profitable. So because, I add to winners and I starve losers, they're all -1, and I use fixed fractional. So I risk 1% of my portfolio. Without boring everyone to death with this stuff, it's how big your winners are. It's not how often you're right. So
brilliant. That's it. I love that reply. Can you do me a favor, Jay? Can you take off screen now and go back off share, and let's go through some of the other questions for you, and then you can answer them. Brilliant. So the other question I've got here is from. Let me just see. It's from.
Can I just say
it's
that
from Steve Larat. Do you look at fundamentals when charting these companies?
Obviously, yeah. I'm a growth stock investor. I will trade anything, but all the information is in the numbers for me. I won't follow any stories. I'm not interested. It's nice when there's a theme, but if I don't see the stocks in my screens, all the winning stocks will trade the signal. So if it's rising, it will hit the screens. But yes,
Cool.
you know, I screen the whole market every day, the UK market. I screen the US market every day, and I use a displacement watch list, and every signal and you know, the best growth and the best technicals float to the top of my list.
Jason,
Cool.
you talked
Okay,
there
so
about
another question here. Just wait a second, Pete. 1 second. With another question we've got here from Raj. Are you using moving average metrics to determine the breakouts? And if so, what are they? What are the metrics you're using?
I use moving averages as just a trend filter. So there's an in-depth tutorial on ShareScope about this, but basically, you know, I've got a 200 on the screen. What I shared, the red, the pink red line is a 10-month, which is very similar to a 200-day. If it's rising over that period. That's all we need to know, you know. The trend is up on that period. So I have a time frame. I run time series momentum for my trend model, for my trend filter. I want stocks what are rising.
Cool. Pete, go for it. You've got lots of questions.
Well, quick one related to that is that what you're looking for on breakouts, Jason, as I understand it, is breakouts of ranges, or what I think you call a base.
Yeah.
Yeah.
So
back to that other one quickly. You were asked about fundamentals and you said it's all in the numbers. Do you read the text of trading updates much at all?
I do. Obviously, everything I'm in, I read, but I trade towards growth. And, you know,
it's in the numbers. Yeah.
It's in the numbers.
In the numbers.
And, you know, you read the report. You're reading a report from a salesman.
Yeah.
It's in the numbers, you know, and
no, it makes sense to me. Makes sense.
Okie dokie. Like, say thank you ever so much to Jason at Self-Serve. You can find him on Twitter doing his trend following, and he's one of the best in the game. So please follow him on Twitter and follow him on. I think are you on Instagram as well? Where are you, Jay?
No, I'm not on Twitter very often, am I?
No, not often. But where else are you?
To find me, you'll find me on my Twitter or on my tradingbasis.co.uk, and the links to YouTube. I'm trying to do more on YouTube because it's visual.
Yeah, well, we'll put you out there, mate. So don't worry about it. We'll get you out there. But I want to thank you ever so much for that, Jace.
Thanks
Thank
again,
you very
guys.
much for coming on the show, fella, and we will see you again soon. If you could just arrivederci for us and take the video off. We're going to answer a couple of questions from some of the other punters that we've got online. Thanks, Jace.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
That was
fantastic.
Self-Serve. We've got a couple of questions, Pete, and one of them is directed to you and me. Are you ready for this?
Well, can I just say, I love what Jason does. And can I also say, we did a podcast with Jason, well, probably a year or a year and a half ago. So if people look through the archive, they can find a whole podcast that is just with Jason, and they'll get a lot more understanding from that about how he does position sizing and his fractional thing and his stop losses and his breakouts and whatever.
Absolutely, absolutely. So this is a question from our former guest, James at James1N1. I think I've got it right this time. When you get to the question, so that's what he's actually that's actually what he's asking us as to when we get to the questions. But I'll ask the question now. So the question James wants to ask is, which 1/2 stocks are right at the top of your watch list right now if spare cash arose tomorrow, and why? Peter, go for it. You don't own it. It's on your watch list. You've got the cash, and you're going to go on it tomorrow.
To be honest, he's completely floored me with that one. I mean, I would have said W7L was at the top, but I bought it last week. What interests me at the moment, I'll be quite honest with you, what interests me at the moment is buying more of what I have. So I'm not really actively looking for any new stocks. So I've currently got 35 stocks in what I call my main portfolio, and I want to get that down to 30. So I'm actually doing an exercise of trying to reduce. So I'm not actively looking for new stocks. I'm just looking, what can I buy more of? In my income portfolio, which has got 15 stocks in it, I keep thinking about, maybe moving on from AstraZeneca because it's had such a strong run, because the valuation starting to get stretched. Does it really fit in an income portfolio? And one of the stocks that I was very tempted by to replace something in my income portfolio was Phoenix, PHNX, or Legal and General, LGEN, and possibly like a green energy stock. But because I've got, Shell, an oil company, which is obviously an energy stock, and I've got other stuff related to energy, I was sort of put off for now as to buying any of those sort of green energy plays, like the solar funds and the wind fund, like TRIG, isn't it? TRIG, and US Solar Fund, which I think is USF. There's lots of really interesting stocks in that arena, but that's all I'm looking at the moment, really. But I'm not actively doing much at all in that sense.
Okie dokie. So to answer your question, James, there's two stocks on my watch list at the moment. Sorry, not two. The two at the top of my watch list at the moment are Sayona Lithium, that's based in Australia. It's a lithium play, as it says. And the second one is Weight Watchers in the US, because we're heading towards the summer. Lots of people are going to get into their bikinis and bathing suits and look suitably buff. So those are my two at the top of my watch list that I'm watching right now. There's a third stock, which I think you have cottoned onto, which you actually hold, which is based in the UK. Ticker begins with a T. That's the third clue. That I've got very high on my watch list. That's my third choice stock I'll be looking at. And this month, I'll probably be buying that stock. I hope that answers your question. So another question we've got further down here. Oh, we've got a compliment here, Pete. 1 second, I'll go to that.
Oh, love that. We'll have that
every
one.
day is a school day. For two guys just having a chat with no great plans for the podcast, you deserve praise. I hope you receive this evening. And thank you so much for devoting your most precious time. My question.
Thank you.
Question. Can you recommend a book that gives an insight into how to read company accounts and what to look for in a user-friendly format? Peter, which book would you recommend?
Well, if you're going to go for a user-friendly sort of initial introduction kind of thing, I would look for Accounting for Dummies. The yellow for dummies books. Get one of those. They're the best way to get into things like that. Read that. Then you can probably move on to something more advanced if you feel you need to. Something like a book by Phil Oakley, I think, has done a book on accounting, which I understand is very good. Who's that other guy who's done one on accounting, Pete? Oh, he's disappeared. He's gone.
You're talking about Mr. What's his name?
Yeah,
Mr. Stephen Clapham. You're talking about
Steve Clapham. Yeah.
The Smart Money book. That's definitely a good one, but it's not a beginner's book. It's a heavy book. Exactly. It's really well worth reading book. But I can't think of the main one. There's one that's on the back of my mind, and I'll have to maybe write it up with the podcast bit later on. But there is this one which no one talks about. I think I read a lot of books that are out, 10 years, 20 years ago, and so on and so forth. And everyone talks about the most recent books because that's what they're most familiar with. There's this book here. I just had to get up off my chair to grab it, and it's called The Undercover Economist. And that goes through not necessarily RNSs, but how to read through the data. So you become your own economist to read through all of the churn of information regarding data regarding companies. So that's quite a deep book here from Tim Harford. I'm sure our second guest will probably know about that book. So let me try and find, I hope that answers your question, by the way. Let me just find another question before we get our second guest on. I hope our second guest is getting prepped now to deliver his chat. Let me just find one more question.
Well, get his makeup on and stuff, you know.
Yeah.
Powder
Wigs
in
and
the
everything.
nose, you don't want to glare, you know how it is.
Let me go. Oh, what can I see here? This is a difficulty with.
I think
I can't find the question, so I'll ask the question I was actually printed out. I actually printed out a question, so bear with me, folks. Sorry.
While he's finding that,
question?
On the accounting one, I think that is the point that if you're completely new to it, a lot of these books are just going to fry your brain. They're not going to interest you. They're just going to be tedious beyond belief. So get yourself Accounting for Dummies first of all. That'll give you a grounding in it. It'll probably give you most of what you need. If you feel you need more, you can then move on and buy a more complicated book. But I suspect for most people, Accounting for Dummies would be absolutely perfect.
Okie dokie. Right, let me just find this question, Pete. 1 second. Right, so this is from Ben, Go Left Massa. I'm not sure he's going to be with us still yet. If he stayed on, that's brilliant.
I think he's down there.
He's down there, good. So Ben is I think he's actually listening whilst he's looking after his little one that was born in November of last year. So it might be bathing time now, Ben, but I'm going to be posing this question for you anyway. So thank you for sending this question in. And this I'll get Algy to answer this as well later on. We were lucky enough to welcome a little baby girl into our lives in last November. I'm finally sleeping enough to put my mind into long-term investing plan for her. My question is, if you were allowed to start over today, Pete, yeah, and to me, with a 50+ year time horizon, with regular contributions flowing in, what would you look at to do? Obviously, I'm seeking and asking for preferences, not seeking financial advice. You've got 50 years from today to invest, Pete.
Wow.
Yeah, with regular contributions, pound cost averaging here now, not just lumping in.
I think the obvious thing to do is you need, I mean, it depends how active you want to be. I would suggest inactivity is probably not a bad idea. I would say you want a spread of maybe 6-7 funds, something like that. An obvious fund to have would be technology, because I think over time, yes, you're going to get massive pullbacks, massive volatility. But I think over 50 years, you'll see technology just continue to be an incredible sector. I think healthcare is another sector you need exposure to. For the same sort of reasons that we all know, aging population, technological advance within healthcare, et cetera, population growth, so there's loads of reasons why that would do well. I think then you'd probably go for like a sort of geographic kind of split. So you'd have, funds in America, funds in Europe, perhaps funds to give you exposure to Asia and stuff, maybe an emerging markets fund. But obviously you'd spread the weightings around. So you'd have you'd probably go for heavier in healthcare. You'd go heavier in the US, heavier in Europe, perhaps certainly a smaller position in emerging markets, smaller position in tech, the more volatile things. That's the kind of approach I think I'd take. Maybe go for a sort of income funds or something. But that would probably do it. I mean, you could consider having some sort of bonds to give it a bit of sort of weight in there, a bit more sort of stability maybe. But I'm not sure the bond model has really worked fantastically in recent years. So you'd have to weigh that one up. The jury's out on whether you would need a bond fund or not. Fact is, you look at any stock index over 50 years, they tend to rise.
Cool. Good answer, Pete. Right. I'll give you my answer on that one, Ben. And I would start with having a look at the historical dividend heroes, the investment trusts that are often talked about. And I would choose a geographical mix of those. So that would make up maybe about 15 to 20% of the little girl's portfolio. And then I would also consider a mix of ETFs that Pete's covered this already, technology and healthcare, but also emerging markets, India, China, the NASDAQ and S&P 500. And I would leave it there. So you haven't got too much of diversification, so that whatever portion of monies that you're putting in per month, you've covered the globe basically regarding that sort of mix, regarding the funds and the ETFs. Would I put anything else in heavier than that? Probably not, because with the S&P 500 and the NASDAQ, you've covered all the technology, you've covered all the healthcare. And with the ETFs covering India, China, etc., you've covered the rest of the world. After you've covered NASDAQ and the S&P 500. UK, I wouldn't even have an ETF covering the UK, to be fair, because you would have covered that regarding the Dividend Heroes, which are usually got, a lot of exposure to the UK anyway. So you don't want to do too much duplication. The problem with having too much duplication, I keep talking to this with a friend of mine that's on the call now, and I won't embarrass him by saying that. You have to look at your allocation of stocks and funds, because invariably there's an overlap and an overlap and an overlap, and you're paying the charges for 3, 4, 5, 10 different funds, but you've got an overlap, which if you compressed it, you'd only have or need 2 or 3 of those funds. So why pay for 10? Why pay for 5? So I hope that answers that question.
Can I just throw in quickly there? Rebalancing and reviewing would be an important thing. So perhaps every year, have a deadline. It needs to be quite a long period of time. So probably every year you assess the weightings of the different funds after the year, and things that have done really well, you might reduce the exposure a bit, and things that haven't done so well, you might consider putting more into. I mean, you don't have to put more into them, but just the simple exercise of going through and monitoring how things will do, because it's really important to keep that balance over time. If you let the balance, over say 2, 3, 4 years, you could have a massively different weightings to the individual things at the end of 4 years to what you had at year 0. And you put all this thought and effort in at year 0 to get your weightings to a nice balance, and it's been completely messed up. So it's really important to have those reviews and to rebalance appropriately.
That we're going to have to differ on, Pete, because
I'm not a financial advisor.
But we're going to disagree on it, because the question was about 50 years. You don't need to rebalance, because you look at the little one is now going to have a child SIP, for instance, right? Or a lifetime ISA. 4 years of age, does it need to be rebalanced after 4 years of age? No, because things will change again over the next 4 and the next 4. Yeah. So as an adult, we should be looking at rebalancing and reviewing on an annual basis, maybe. But for a 4-year-old,
no,
probably not.
No,
Are you with me? Probably not for a 4-year-old.
No,
you forgot the bit about the fact that this is a child that's now 0 age. Yeah, is now 6 months of age, going to be going on to 50. So the balance inside of it, I don't think so that frequently every year. So we can differ. We don't have to agree.
Yeah.
Okie dokie. I'm going to ask Algy to come out now. Algy, put on your screen, please. Put on your makeup.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin PETES promo code, and you can save up to £69. Visit sharescope.co.uk/sharepad for further details and subscribe to the investing and trading analysis and data you need.
Hi. My makeup
Okay,
is
ladies
on,
and gents,
all applied.
we've got
Hello,
Algy
guys.
Hall, formerly of the Investors Chronicle, now at Citywire, doing his bit as the editor of Elite Companies. Algy, tell us a little bit first, mate. Well, firstly, thank you ever so much for gracing us with your presence, because we bow to your excellence. Firstly, tell us a little bit about Citywire and Elite Companies before you go on. I'm sure you're going to be talking about a book that you've got to your side there. I'm not sure what that's about, but tell us a little bit about Citywire first and what you've been doing there, and what the team is looking to do, and anything you want to share about that, so people start following you on Twitter and social media and elsewhere, please.
I just before I start, just huge congratulations for the 100th show. It's terrific, and I think I'd echo the thanks that's already been on the chat for everything you do, because it's really wonderful. So hats off to you.
Thank you very much, fella.
Thanks, Algy.
Thank you. And can I just say before you start talking, anyone that wants to ask Algy some questions, start putting them in the chat, please. Algy, go for it, mate. Thank you ever so much for that. Those kind words. I really appreciate it.
Oh yeah, no, not at all. So what I'm doing at Citywire, I left the Investors Chronicle about a year ago because I was approached by my old boss from a long time ago. He had he's always wanted to track where the smartest fund managers are putting their money, and he was him and the co-founder of Citywire that got all the holdings of that identified all the best fund managers in the world, about the top 5%. They'd got all the holdings and they wanted to do something with it. And I'd got quite interested in this research, which looks at how the highest conviction positions of fund managers tend to outperform everything else in their portfolio. So it's this idea that, I mean, you may be familiar with it. A lot of people say there's no such thing as skill in investing. It's it's only luck that you're seeing. And the proof that's in the pudding is that fund managers can't outperform the index. Whereas this research kind of actually looks at it in a slightly different way and says, well, actually, their top holdings do seem to outperform the index, and this is where their best ideas are. So I found that fascinating, and I was running screens actually mainly used by the journalists at the Investors Chronicle for generating ideas there. So I was presented with the possibility of turning it into something else. So over the last year, we've had to come up with all this kind of inventive. I mean, I say we because I've lent heavily on the stats people, the data brains at Citywire to do it. But we've come up with a methodology which allows.
Oh, I think he's frozen. Is he frozen for you, Pete?
It's frozen a little bit. Hopefully, Algy will be back with us shortly, folks.
Yeah. Can you hear me?
You just dropped out a little bit there, Algy. Just go back a couple of seconds. It's fine.
Okay. My computer's helpfully telling me my internet connection is unstable.
Just tell all the kids in the house to turn the computers off, mate.
It'd take me hours.
So many kids.
Please, mate.
Anyway, basically, we can tell people what the best ideas, the world's best fund managers are now with this rating system. We rate from AAA, AA, single A to plus, and the AAA stocks are the ones where you've got managers making real career-defining bets for them. And it's a really exciting project in terms of the monitoring we've done of it so far. We're getting some really positive results from the portfolios we've been looking at. And also, I mean, what's most important to me is that we're finding just really interesting ideas I wouldn't have come across otherwise. We start researching them, and these are incredibly interesting companies.
Brilliant. No, Algy, we spoke about it on the last podcast, and Pete and I were saying that you'd only been running the metrics for the elite companies for 9 months, and already there was an acceleration regarding the performance of that particular portfolio, already outperforming everything else. Absolutely spot on. The only problem I've got is that I don't have a portfolio that will allow me to trade in stocks in Taiwan. You know.
No. We've got a very broad spread, but I mean, we've got lots of UK stocks on there as well. And I mean, also, I shouldn't over-egg the performance we've got, because, you know, you measure something over 9 months, you're measuring luck as much as you're measuring anything else. So yeah, I don't want to pretend we've got something we don't, but we do have a lot of academic research which backs up what we're doing, which we kind of, you know, which isn't ours, just, you know, kind of, you know, other people have been putting together. So hopefully it makes sense and, you know,
Brilliant.
highlight really interesting ideas for people.
Absolutely. And this is what it's about, research. You know, you put it out there, go away and research it, you know, and then make up your own minds. That's what you're trying to do there, is just get people to think broader than just UK centric, you know, choose the best companies in the world, you know.
And yeah, and ones which have been thoroughly researched by people beforehand. I mean, you think of these institutions, these fund managers who are kind of, you know, they have analyst upon analyst, data, you know, upon data, information we could, you know, never dream of. And they're basing their decisions on that. So it's kind of piggybacking on that a little bit, just to, you know, but then you've got to do your own research. You know, you have to buy your own stocks. You can't, I mean, there's no shortcut around that, really.
Absolutely. So go on, Pete, go.
Algy, yeah, something's burning my brain here, and sort of I'm sort of struggling to remember. I've got a feeling that I read an article in Investors Chronicle was from somebody who'd written a book, and I'm sure this was in the last couple of years. Someone had written a book and it had come up with what you're talking about. So it was the idea that fund managers, some of the best fund managers, were really good at choosing very good stocks really well. But what they weren't so good at was at cutting their losers and stuff. Is this ringing bells?
Well, yeah, no, I mean, it rings 3 bells, actually, Pete.
Brilliant. Ding, ding, ding.
One is a book called The Art of Execution.
It is Lee Freeman Shaw.
Yeah.
I did wonder if it was that. I've read that book. Yeah.
Yeah. So he kind of identified some managers being good at something, some being good at other things. So then there was a very there's quite a I think quite well picked up research paper as well, which kind of looked at how portfolio managers went about buying and selling shares, and it found they actually generated outperformance with the stocks they purchased, but then they actually lost all of it and more again by the timing of their sell decisions, which I think probably everyone is familiar with that. It's kind of like, it's very, and you were talking about it earlier, it's the finding something to buy is the fun bit. Deciding when to sell is really hard and really painful. So it's like, having, and there's just, they're almost separate disciplines. So, the more process people can put in place, and, the more independently people can think about sells, the better, really, I think was probably the conclusion of that paper. And
Absolutely.
Then also,
every day is a school day has reminded me of the name of the book. So it's The Art of Execution by Lee Freeman Shaw. Really interesting book, very easy to read, not heavy going at all, well worth reading.
Yeah,
I think Algy just said that. So bear with me 1 sec, Pete. What we're going to do now, we've got some questions piling up for Algy. So I actually want Algy to talk about the book now. Yeah. So please proceed. No interruptions, Pete. Let him just chat about his book, and then we'll get some questions to Algy. It's Algy, not Algy, Pete, as well. It's Algy.
Oh, don't worry about that. Listen, when you're given a very stupid name at birth, you just roll with it. I've been called all sorts.
You must get called that all the time.
Oh yeah. No, I mean, the names, the permutations of my name are huge. I've left. Why not? It's a really silly name. No, not that. Anything but that. Anything but Mr. Hall. Yeah. So Pete, you're holding up my book, and yeah, that's it. 4 ways to beat the market. So this was, this book has been a long time. It's been 12 years in the making, because it's based on it's based on a column that I wrote for the Investors Chronicle about stock screens. So these screens, which I'd refresh once a year and monitor how they did. And about 5 years in, I think, I kind of they would, they did far better than I ever thought. You know, and like not all of them were, you know, brilliant, but it was, you know, it kind of really blew my mind how well they did. And I thought, you know, I should do something with this. And I was approached by Harriman House around the same time to see if I'd like to write a book. And I thought, well, it's a bit, you know, it's a bit early really, but you know, this is an interesting, you know, idea. And then I found myself 5 years later, having, you know, tracked these things for 10 years, thinking, okay, well, if I'm going to write a book, it's going to be about this probably. So I went back over all these screens, and they're about at 40, and tried to figure out, you know, what were the common themes, and you know what actually really seemed to work and make sense. And essentially I ended up with 4 screens, and really you could have you know, in some ways it's quite predictable, but because what is at the heart of all the 4 different strategies is very well known and well measured phenomenon in markets. It's kind of, you know, it's I wrote down what I was going to try and say about them. It's essentially all the strategies, they're looking for things which just have a tendency to be overlooked by the market. But also, you know, the idea of the book is to explain why they're overlooked, and then go into the practicalities of, you know, what you should be looking for if you want to find this type of situation. So you know what type of situation you want to find, then, you know, how are you going to actually find it using fundamental data, which, you know, most people can get if they pay a subscription for something like ShareScope or SharePad. And then also just looking at, you know, how once you've got, you know, a list of stocks from a screen, you know, how you're going to actually identify the stock which is good from the stock which is a dud, a kind of false positive, as it were. So the book tries to do all of that, and also it goes through company accounts. Hopefully hopefully it explains it in them in a straightforward way, and ratios, and you know, how you go from the accounts into fundamentals, which you can kind of, you know, really make sense of stocks from. So yeah, I think that's hopefully a little summary of, you know, what the book is. There's also a very good testimonial from one Mr. Peter Higgins, which I'm extremely proud about, in which is inside the jacket.
Very, very kind of you, Algy. I mean, for me, and I said this almost in the book as well. What fascinated me was I felt like it was written personally for myself, because I'm quite selfish like that, because it was just interwoven throughout with psychology, because the market is just always on the flux, always moving around, always battering us and making us think all of the while. And the purpose of the book is to get us to think, and the purpose of the book is to get us to look, and the purpose of the book is to get us to research. But the most important part of all the things that we've got to do is about our mindset. And if we haven't got this intact, the market will just throw us out of the market. Yeah. So it's so important to manage our psychology. And this book enables us to do that by giving us all of the tools to navigate the markets. So regardless of what's going on, we've got 3 or 4 or even more strategies to navigate the market with. And that's what absolutely I loved about it, Algy.
Oh, thank you. Yeah, I mean, I just thought that's such an important and powerful thing for, you know, for anyone to just know what you're doing, kind of thing, because the stock market's massively confusing. Company analysis can be massively confusing. You know, these stories are complicated, and it feels like, you know, how do I find what's really important, so that I can, you know, actually make a good decision. And so you know, I mean, that's when I kind of, you know, sat down to, you know, thought through it a lot, and that really, you know, rose as to come, you know, this is the most important thing I can do if I'm doing anything with this book, is just to, you know, help the reader understand, you know, why you would want to do this, and then, you know, and then how you're going to research it, and then actually feel comfortable with the holding income. Like, you know, when markets go mad, just, you know, you've got something to hang on to, and you've got a benchmark with which to judge your investment against, because you know what you're expecting from it, and you know why you are buying it. So you just will be that much harder to knock off course. And if you need to sell, you know, you'll know why you need to sell. Is the idea.
Absolutely. So go on, Pete.
Algy, I've read your screening column in Investors Chronicle, up until when you left probably a year ago. I read every single one.
Oh, thank you.
Forever. I
Very
mean,
flattered.
how long do you think you did them for?
It was just over 10 years because
Was it? Wow,
I took the job offer at Citywire, and I had to give 3 months notice, and I thought, okay, for the book, will I actually do the final 10, because the last screen finished in, I think it was the end of December 2021. That was got it to a 10-year track record. And I was just there still. I left in January, so I just got a 10-year track record for the last one.
Wow.
Which was actually very similar to what Jason was talking about. The last one was a momentum screen using fundamentals as its kind of, it's the back, to help it as well as price. So the fundamentals kind of complemented the price action.
Yeah, that makes sense. I mean, I loved your column, and the bit I really liked was that you always wrote what the criteria were for the particular screen. And I always love reading through those criteria and thinking about those criteria and thinking, how can I apply that to what I do, my rather higgledy-piggledy hybrid kind of way of investing? What bits can I pinch from your screens to help that? And I found that really useful. And as you say, so many of the screens really perform well. Some of them were duds, but most of them performed so well, and it was really good stuff.
Also, what was really interesting when I went back to them and looked at the ones which had performed well, those were the screens which I could really make sense of properly.
Yeah.
And and also I think that's the thing with setting out the criteria, and kind of, you try and build a little story when you when you build a stock screen, and as with all stories, you can change them around a bit. You can still there are a million different ways to tell the same tale. So I mean, the way you use them in terms of taking little bits out and doing things with them, or just using the ideas, that's entirely what they're meant for. Like none of it's meant to be set in stone, because it's actually the ideas behind it. That's what's important. If you've got the idea, you can then you can stick with that and do loads of other things around the outside.
You always used to say, within the article, you always used to say, the purpose of these screens is not to have ready-built portfolios. It's more to study the process of how you build a stock screen. And you always used to say that, which was brilliant.
And I mean, also, I think if anyone who kind of just relied on a screen to build a portfolio is going to end up being panicked out, because you don't know your holdings. You've got to know your holdings. When a price lurches down, you'll feel like a genius when it's gone up, but as soon as it lurches down, you remember you knew nothing about the stock. So
yeah, what does my screen tell me about when it falls? Yeah.
Okay. So Algy, what I'm going to do, Pete, bear with. What I'm going to do now is just ask you some of the questions that's in the chat. Otherwise, Pete's going to ask you another 10 questions before we even get there. All right. So Algy, this is from Matthew Gregory. That's in our it's live with us right now. So thank you, Matthew, for this question. And he said, Algy, when it comes to screening the UK, especially for quality, are you finding that it's always the same names that keep turning it up? Is this just a side effect of the UK market, or do you have any tricks for turning over new stones? Fantastic question, Matthew. Thank you.
Well, I think when I look back, I've got an appendix in the back of my book. I'm just going to turn to it. But there was, I always had a year between each screen, and over that amount of time, you get a bit of churn. But the thing with a quality screen is that you want the same names to be coming up, because genuine quality and genuine compounders, they're incredibly rare, and you want to see them delivering year in and year out. So in a way, it's kind of like, not having any fresh quality ideas isn't such a bad thing. But I think with the criteria I had, you got a fair bit of turnover from year to year. But also you can change the way you're screening for quality, by just focusing on different metrics, and you may actually come up with something something which is interesting, which didn't appear on one screen. So you could go for gross margin or something like that, which is a classic metric for this kind of environment where you've got inflation. So, and you're looking for pricing power, let's say. So you could use something like, gross margin to see if you can find something interesting. I mean, also in my book, I have a screen which looks for shares which have low volatility and they're consistent dividend payers and yield, pay a decent yield. And the more I wrote and thought and researched about that form of investing, the more I thought, actually, this is actually just quality by a different, by a different guise, and it won't be recognized by, the people who are looking for, high return on capital employed or whatever your quality metric is, because, looking for consistent dividend payments, that's not a classic in low volatility in share price. That's not a classic way of looking for quality, but actually what you end up with gives you quality of a different sort. So I mean, I think there are quite a few ways around thinking about the question of quality. But also, yeah, but I think, yeah, to answer your question, Matthew, I think, yeah, with quality, you probably, you are going to get quite a few of the same names reoccurring, or, your Diageos and your Unilevers, because they just can make a lot of money with every pound put into their business.
Yeah, thank you for that, Algy. Brilliant question and brilliant reply. We've got another one here from James at OneJames1N1. Algy, how do you measure or identify conviction? Is it by looking at the weightings fund managers give to stocks, or something else?
Yeah, so we look at the weight, how overweight they are, but then because we've got, I mean, one of the hardest things we did is because we're looking at lots of different fund managers. We want to aggregate all of their judgments together. So our rating, what makes it really special is that it's like lots of judgments all kind of like put into one rating. So we had to find a way of standardizing those overweights. And you've got some fund managers holding 10 stocks. And you've got some fund managers holding 500. We've got one fund manager who does amazing stuff that holds 500 stocks. So we had to find a way of standardizing it so it's not just how overweight a manager is, because for our manager who's holding 500 stocks, a really risky bet for him, or kind of really high conviction bet, is going to look very different than the manager who's holding just 10 stocks. So yeah, there's statistical trickery in the background to make it possible to make comparisons, and and then we kind of we aggregate.
Brilliant. Algy, I'm going to ask you this rather profuse question, right? It's a bit random. You speak about 4 ways to beat the market. Okay, the opposite of that are ways to actually lose your money on the market. Which is the continual recurring mistake that most investors make when losing money and getting beaten by the market?
Like that question.
God, what a good question. I don't know if I've got a very good answer for it though. I mean, I think I suppose actually probably. I mean, I'm kind of thinking to psychology here, because it's that we've all got these universal traits. And I think holding to the bottom is probably, the thing that we're all most prone
That's
to.
me. I'll watch them go all the way.
It's also humans. It's all of us. Yeah. It's because I mean that's what we're pre-programmed to do, because we have these dual things. We've got the endowment effect going on. We've also got loss aversion. And the endowment effect is this very, very well studied thing where you feel different about something when you own it.
Yeah.
And like most people know it in terms of you put more value on something when you own it. But there's also this really interesting research into what happens when you've got something dynamic going on. So in like a share price moving around. And what seems to be the case, I mean, all academic research has come out, it looks probable that. But what seems to be the case is that if you're holding something and it goes up in price, you love it more. So you start off loving it more than you should. And if it starts making you money, then you start to, you just go, whoa, this is the best thing ever. It's like, I love it.
So
But the reverse happens when you start losing money. You start to hate it more than you should. So you loathe
true.
it, you loathe it, you loathe it, and your loathing builds up. But at the same time as you're loathing it, there's this other really powerful psychological thing going on, which is loss aversion, which is we hate losses. So it's like, so we don't look at a losing position as in I've got X amount of money that I can now invest in, whatever else. We look at it as I've lost this much money. We forget about, what else is there. So we can't sell it. So it's like, it's really hard to sell, and we're hanging on. And like, we've all, this is like just common to everyone. Everyone, should, if you haven't ever been in this position, you're not quite working, in the same zone as the rest of us poor mortals. But
so Algy, what's your solution to the problem of falling shares? What do you do yourself?
Well, for me, I because I'm a journalist, I can't actually invest in anything, and I think I'd make a terrible investor because I'm such a scaredy cat. But what I do with my own portfolio, I just rebalance. So that's I can invest in funds and I rebalance. So which is just like a very effective. If you're in like big portfolios, you can deal with it that way. So it's just like, but rebalancing is hard. You have to make yourself do it, and you have to do it through gritted teeth because you're buying into a losing position.
With funds, you don't really have the problem of them dropping from like 800p to £1.
No,
a fund will drop 800 to maybe 600. It's not gonna, collapse in the way that individual stocks do.
And and also if it's a diverse portfolio, it's you're not going to look at a case of game over. It's like, in asset class, if you've got something in a specific asset class, and in suddenly that becomes a moribund asset class, then then you could. But I mean, normally most funds are so diverse, that's not going to be the case. But so in terms of individual shares, though, which is what you're actually asking about. I think the best advice which is out there is essentially just deciding what your reason for owning it is beforehand. And I kind of spoke about that when I was talking about my book, I suppose, a bit, but a lot of that comes to just writing down your reasoning in a concise and clear to follow way, because you will forget, it's human nature also, we know, to just forget what you thought we're thinking at the time you did something. It's kind of like, when your memory is like a very unreliable guide to these things, which seems like crazy. But as soon as you start keeping a kind of investment diary, or kind of, or you kind of like, writing things about companies and go back and look at, articles you wrote and go, oh my God, I can't believe I wrote that. What was I thinking? I'm sure I didn't think that. But you kind of like, you lose sight of what it was, the reason you were first doing something. So I think that, the best and like really easy thing people can do is just write down exactly what, why you're investing, what you're expecting, and use that as a reference point. And sometimes things change, so you can update it and say, actually, now I think I'm going to stay in because of this, or, that's changed, but I think that's, I can understand that in the, broader scheme. So you could, it's this idea of journal keeping essentially, but you have to start off with that. Why am I doing this? And if you're really good at journal keeping, you'll do things like, do a pre-mortem. You'll write a pre-mortem is the idea that you're, 6 months, a year down the line, whatever that is, and it's all gone terribly wrong, and you write out why it's gone wrong. You can also, another thing which is, meant to be very powerful is you write out a bear argument. Before you buy something, you write the bear argument against it. So those are two tricks you can add to your journal keeping.
Is that stuff in your book?
No, my book goes through other things, but it doesn't do the whole thing about journal keeping, because
this will be
a book in itself.
Then.
Was that?
This will be in book 2 then.
It's book 2. I did write an article on it once, actually, so I've got a very long article on it.
Right. So Algy, thank you ever so much for that. Thank you ever so much for answering the questions as well. Excellent. We can't go before we ask you, A, where do people find you on social media, as in on Twitter? And also, what is the release date and where can people purchase the books?
Okay.
The books, as in they buy more than one, yeah?
Oh, yes, please. So thank you very much for having me first. And the release date is the
You're very
16th of
welcome.
May. So 16th of May, it's out. It's available to pre-order now. I'm on Twitter at Algy Hall, and my name is spelled, my very silly name is spelled ALGY, and then Hall, HALL. I'm also trying to make more use of LinkedIn, and there I've got the even sillier version of my name, which is my full surname, which is Algy Craig Hall. So I'm there. And then also, if like, please come and visit the Citywire project. It's citywire.com and then /elite-companies, and we've got a weekly newsletter that basically just rounds up all of the ideas we've been looking at, all the articles we've done, all our top 10s, all the screens that I'm doing on these lists of fund managers' best ideas, and yeah, hopefully that'll be kind of worth the slot on a Tuesday in your inbox.
Brilliant. No, thank you ever so much for that, Algy.
A lot
You've
of
been
plugs.
absolutely fantastic. I wanted to say, I'm going to open this up for anyone that's on the current live chat and anyone listening to this podcast going forward. All I'm asking you to do when you see the tweet that goes out, probably after Friday, maybe next week, is to tell me how many books, there's a clue here in the books, that Algy has written thus far. And I will wing a copy of this book to you as the winner of the question. How many books has Algy Hall written? That is the prize. That is the prize. That was the question. Thank you very much.
Is that a trick question?
Algy,
I
thank you
think
very much.
It may be worth. Do you think it's worth saying it's a?
Don't say it. Don't say
Oh, I
anything
won't
at all.
say anything.
Just leave it out there. The whole point of this podcast is to get people to do a bit of thinking and a bit of research, Algy. Enough clues, mate. Thank you ever so much. We'll speak soon, and I'll be posing that question as well, Algy, at the UK Investor Show on the 13th of May. So anyone that's listening to this podcast, please visit me at the UK Investor Show. I'll be there with the Investing Matters team. I've got a panel of guests. I'm not going to tell you who those guests are, but I've got, yes, I am. Sorry, I will tell you. I've got Gervais Williams. I've got Stephen Yu. I've got some other people as well. I can't even think. My brain's gone at the moment. But I'll be posing that question again at the UK Investor Show, so somebody can actually pick up a copy on the day and get that particular book, the best book at the moment, which is 4 Ways to Beat the Market. Right, ladies and gents, we have done 90 minutes. And what I'm going to do now is I'm going to go through some of the questions that were directed to Pete and I, and then we're going to wrap up. But as I said at the very beginning, we're going to stay on here and have a chat amongst ourselves. So for those of you that wanted to know about the book, 16th of May, it's released. You still can buy it. Well, you can buy it pre-release now. There's a comment from Michael T. Algy Hall, very good to hear you think fund managers, high conviction picks do very well, as this is the strategy that many PIs follow, including myself. I asked Matthew's question. Algy, I've asked James's question. There's a question to me and you here, Pete.
Wow, excellent. Hey, can I just say, Pete, can I just say, I don't know if you knew, there were 22 people on the call at the high point. We're now on 21, which is fantastic. And it's great how so many people have come and joined us. It really made a great evening.
It has. I'm surprised people have stayed, to be honest. So
we've only lost one, and he politely thanked us. So that's brilliant. Thanks, mate.
Yeah, that's very, very kind. That's very, very kind. So this is, I think this is from Raj. What would you both say is the ideal number of stocks to hold to ensure you're diversified as well as not diluting your gains? Let me just say, Raj is terrible at this, and he's asked this question 1,000 times, and he's done bugger all about it. So go for it, Pete. You answer this question. He's not going to take any notice of the answer, but answer it anyway. Go on.
You know, it's funny because I've been here myself. I mean, I started doing wheelie dealer back in the tail end of 2013, 2014. And one of the big things that doing that really brought home to me was discipline, because the whole world is watching what I'm doing. So I get so many people saying, why do you hold so many stocks? And it really sort of like helped me get the discipline to bring it down. So I'm pushing down towards 30 in what I call more my sort of trading portfolio. I think 30 is probably about the most that really I should go to, and probably anyone should go to. There is a theory that you can have 20 stocks and that will give you diversification. I do know people drop as low as sort of 12 stocks, 10 stocks. I've even got a good mate who only holds 6, but I wouldn't recommend that to anyone unless you knew how he does it. In terms of my income portfolio, which is more of a sort of do nothing, totally boring, totally leave it alone kind of portfolio, which relies on the dividends, I started off having just 12 stocks. I didn't really feel comfortable with that, so I pushed it up to 15, but I'm going to be really strict on 15. It's got a lot of diversification within that 15, and it's very much boring, do nothing, leave it alone.
Brilliant response. Thank you for that, Pete. I'm currently sitting between 35 and 40 stocks. Everyone knows I'm overweight significantly in AstraZeneca. That's the largest weighting in my portfolio. It has been for a significant amount of time. And what I've been doing over the past, well, I started last May actually, so it's coming up to 1 year of me doing it. I've been scaling back the weighting on my AstraZeneca portfolio. And my plan has been, and it's been executed recently, is that each time it goes up another 100%, I've been taking off a tranche of those shares. So as I've been doing that, I've been looking at other portfolios and other stocks to invest in within my portfolio. And I've been going into the REITs and infrastructure plays and renewables. So that's now incrementally adding to the numbers. So that's probably going to end up above 40 for my portfolio, if not above that, depending on how far and high AstraZeneca goes. So my ideal weighting, if I accelerate my reduction of AstraZeneca, will probably end up being sub 30, and I'll increase the weighting of my most recent portfolio additions. But there's a very important caveat here that I think that most people should have around 20, 25 stocks. I think the issue should be when you get a really significantly large portfolio, you want to have that added diversification. You don't want 15, 25 or 35% in one stock if you've got a significant I'm financially free portfolio, because if that one stock gets hit and it's got a 15, 20, 25% of your weighting in your portfolio, it could send you back to work. Right? So you do not want that.
Forbid,
it's a bit. I've got individuals that back, the last time that the property and houses got hit, all of their wealth was tied up in houses, and they were fire selling these properties because they were a landlord, and as landlords doing it now because they're seeing the interest rates going up on the loans that they've got, and they're now selling properties, but they can't get rid of them, so they're still paying the mortgage on, the rent, the loans that they've got on these houses, whilst trying to get rid of them at the same time. So you've got to be very, very careful of the weighting and exposure you've got to any sort of sector. So to answer your question, Raj, which I've told you again and again and again, it's between 20 to 25. And going back to the other element that he's not asked about is the funds side of it as well. There's no need for anyone to have 30 different funds unless that's all they've got is funds. Just decrease it and maybe have 15 funds, because most funds have got a global reach. So that's to that question. I'm going to go to Roger Green's question now. Pete, you can answer this first if you wish.
Yeah.
Peter and Pete, do you think the markets will surprise us to the upside or downside for the rest of the year? Pete, go.
Well, because of the way you've worded that question, Roger, I would be surprised if they went down. I actually expect them to go up rather than down. But my expectation is a very tedious, grinding summer, and then possibly a sell-off around October time, autumn time, September, October. We always get that. And then a good run into the end of the year, because that is the normal seasonal pattern. So that's what I'd expect. So yeah, so a surprise for me would be a big drop.
Okay, I'm gonna because I'm a contrarian to the bullishness of the markets, and I've actually been quite negative, although I've been in and out of the markets and navigating it as best as I possibly can, and I've been chinned a few times because of that with markets. I actually think that the markets could struggle for the rest of the year. I want them to do really, really well. I want us to beat the highs that we've had year to date of 8,024, I think it was, Pete, that we had as a high, or thereabouts. It should be relatively easy, because last podcast we spoke, we were within 1.5% of breaking that high. As I said earlier, we're now at the 777, we're at 7,773. So we've now got to do 300 points before the end of the year, which should be really, really easy. But there's noise all over regarding the markets. We've got the, this might not sound interesting to most people, but you've got the media, television production, Actors Guild, blah, 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 Writers Guild going on strike in the US. We've got the debt ceiling conversation going on in the US. Yeah. We've got the general election, sorry, the elections coming up. Yeah. Local elections coming up this week up and down the country, depending on what happens there, so on and so forth. Yeah. We've got the lows of the summer when everyone just, should be chilling out and relaxing. Yeah. So we'll have to see what happens, and will we have any more interest rates in the US? Will we have any more interest rates increases in the UK? So tomorrow, for me, let me just finish answering the question, Pete. For me, I think there's more downside in, and I raised the issue about the banking issues in the last podcast. And what did we have this weekend? We had First Republic being seized by the regulators, and JP Morgan snapping up, 18 billion worth of assets there or thereabouts for 10 billion. So there's more bank issues afoot, folks. Yeah. So for me, I'm cautious. Yeah. I'm looking for downside, but praying for all of us that the markets carry on climbing this wall of worry and we do well. I do not want the markets to get spanked. It's not because I'm personal, but for everybody. Because every single thing else that we're impacted by, food, water, shelter, everything else has gone up. And for some of us, the one thing that we'd like to go up as well with all of that other stuff that's negatively impacting us financially is our portfolios. Some of us, Jay Stelserve, Jared Maloney here, yeah, myself, and a few others, have got most of their wealth tied and exposed to the stock market. Yeah. Other people have got other jobs that they do. Yeah. So for those of people that are retired and their income is dependent on the portfolio and the income within their investments, I don't want their portfolios to go down. So I'm erring on caution, but I would love for the markets to carry on creeping up and fight this wall of worry.
Absolutely. Can I just throw in something I noticed literally 5 minutes before we started recording this podcast? I hadn't really noticed it before. If you have a look at the Dow index, the Dow Jones Industrial Index, it has actually gone nowhere in 2 years. It's been in a sideways range for 2 years. I hadn't really noticed that. It's quite a wide range, but it's been in a range for 2 years.
Cool. Yeah. And our market's been there for 10 years, Pete, if not more. When did it first break 7,000?
Well, you say that we have actually been pushing up recently, so we've got out of whatever
for 10
range
years,
we're in.
But for 10 years we went nowhere. James will tell you we broke out when we went above 7,000. So I'm just looking for another question here, and then we're going to call it a wrap. But we're going to allow everyone to just stay, and then we're going to have a chat and see what else we've got here. Right. No, I think that's all of the questions. Okay. Oh, sorry, there's loads of questions at the bottom I've missed. Sorry, apologies, guys, ladies. Right. Bear with me. Got something here from Peter Hodgkins. I forgot to put my hat on. Now I'm speaking lithium. There we go. This is the stock that cost me a fortune and then won me a fortune. So we'll talk about that in a minute. But Peter Hodgkins says he's sitting on 12 to 14 stocks, but I know I'm invested in and down a specialist niche or battery metals, copper and gold, now holding for lithium dividends in production. I'm financially free, so I can take a bit of a risk. Enjoy. Thank you for that, Peter. At Claudio H Fox on Twitter. What else we got from here? We've got a comment from Steve. What is a this is a great question, Pete. You can go with this one first.
Okay.
What is a highlight and a low light of the 100 editions to each of you so far? So what's the highlight for you of the 100 you've done?
Well,
just first thing to your mind, Pete, and a low light, the first thing that comes to your mind.
I mean,
go for it.
A big highlight for me is to actually meet Algy Hall, because I was
Algy Hall
and him. I met him as well. He was on the podcast tonight. It was really good. Now, I've read Algy's column for years and years in the Investors Chronicle, and I've spoken to Algy. Algy, what's his bloody name? Mr. Hall. I've spoken to Mr. Hall.
I'm the one whose English is my second language, mate. Come on.
On Twitter and whatever, I've spoken to him. So I think you had him on the podcast on that one I couldn't do because I was ill or whatever. So it's absolutely fantastic to meet him, and it was really interesting listening to his talk. So yeah, I really enjoyed that, and I also enjoyed at Stealth Surf Jason's one because he's always very, very good. Brilliant.
Okay, and low light, Pete.
Low light. I need to use a loo. No. Low light. Low light is that in my flask, I made the big mistake of putting a tea bag. Can you imagine how stewed and how strong that is after an hour and a half of sitting in a tea? Yeah, it's grim. I tell you, it's grim. It's in here. Brilliant. And it is grim. Okay. But hey, I'll drink it. That's
okay.
A low
to
light.
answer your question, Steve, I think I've got several highlights. This to me is an absolute phenomenal highlight that we've got to 100, that we actually managed to do what we said we were going to do years ago and put on a live event and have people on and actually talk investing with other like-minded individuals. To me, it's an absolute highlight for me. Mentioned all of our guests. Those are highlights for me, that they actually had the confidence and we made them relaxed enough to come on the show. I remember speaking to James about coming on the show, and he was like, what me, why, what? And then he came on, he was so relaxed, so chilled, and what he delivered on that particular podcast was absolutely awesome. So I'll always be like that to James. I think we had brilliant leader as well, came on with his quality checklist. That was absolutely phenomenal. I must say though, that for me, two of the bravest people that actually came on the podcast were proper highlights for me. And I'm not sure we've given them enough credit for actually coming on the show. And these were two ladies. One was Vonnie Leah, and one was Katerina at MTAUS from Australia. However, I'm going to be biased now and say probably my favorite podcast that we had, Pete, because it's just two people I'd always revered, was when we had Phil Oakley and John Newman come on the show, and I was like that, just with my mouth open, agag, as them just extolling all the other bits and pieces to me, and I was just sitting there learning. I think that's probably one of the quietest podcasts I heard you on as well, because you were the same. We're both like listening. You guys just carry on talking and let's just listen, because you've been watching John and listening to John from Investors Chronicle all of that time. And there we were, and I've actually managed to convince them to come on the show. So but all of our guests were brilliant. Secret Accountant was brilliant. Michael
Oh.
T was brilliant. Ryan, when he first came on, he was the very first guest we had.
Yeah.
You know,
He won
very
the
first guest.
competition. He won the competition.
You know, and yeah,
well done. Yeah,
and we had
brilliant.
Go Left Master, and I've
Yeah,
got to give a really big shout out here for there's an unsung hero. We've already mentioned one, which is Lemming Investor, but one of the individuals which is an unsung hero, and I don't really talk about him enough in the sense of how much support he's given me, how he's carried me regarding this particular podcast and other podcasts. When you were poorly, Pete, I just picked the phone up and I went, mate, can you help me out?
Oh.
And he's like, you what? Why? Oh, Henry Viola, without doubt, at HT Viola is probably the most generous, kind, and helpful individual that I've ever met. Yeah, bar Steve Larat, who has been absolutely immense for me for the past 10 years. So those are the highlights for me. What's the low light for me throughout all of this? I could pick on and say immediately it's Wheelie Dealer. That's why he's hiding his face, because of the interruptions. But actually, what Pete does and brings to the nuance of this particular podcast is a highlight. It's a highlight for him. It's a highlight for me. It's a highlight for everyone else, because it actually makes this complete yin and yang relationship where I'm just going like that. Oh my gosh, I'm going to get ahead of a word in edgeways here.
The old couple.
You know, but it works, and that's why we're here with 100 podcasts.
Brilliant.
So what's the true low light for me? I think probably not being able to have done this in a pub, right, live, with everyone there with beers and drinks and cordial and popcorn and snacks. And I will be determined for us to be able to do this. Don't have to wait for 200.
We're going to make it happen.
I think I'll be divorced by then, but from Wheelie. But hopefully we get to another time frame when Pete's well, and we can do this live somewhere, and everyone can come along, and we can actually see each other and give some loves and give some hugs, and and talk about it properly.
Everyone, you've probably noticed me putting my thumb up and waving to people and doing nods and whatever all the way through. A lot of it is I'm responding to messages that I see come up on the screen. Thank you for everyone who's been putting up messages as the call has gone on. There's been so many come up, and you've made some brilliant points, and it's been really great.
Well, one of the brilliant points has come here from Raj, and it said it would never be the same without Wheelie.
What, am I going? Am I off?
No, you see, I'm just passing because of what the comments I made. Yeah, and then we've got from Every Day's a School Day, said the odd couple, absolutely. Yeah, some praise for Henry here, Top Man Henry. Henry's put in, I'm blushing now. He always blushes.
The chat. I mean,
what else have we got here? And Matthew Gregory. It'll be hippos next. We can't forget about the hippos, can we?
Hey, I've still got Hungarian midwives for you, but you ain't getting them tonight.
For heaven's sake.
You're going to get them in 101. I promise. It will happen in 101.
Okie dokie. Right. Ladies and gents, we've been running for nearly 2 hours. I'm not sure the people that are actually going to be watching this physically when they're in their cars, or, sorry, not watching the video in the car. Don't do that. Sorry. Apologies. Watching this in their homes or listening to the audio on the trains or whatever will endure an hour and 50 odd minutes, nearly 2 hours. But we are going to call it a wrap at this stage here. Everyone, please stay on. We're going to call it a wrap here. For those that are listening, and for this now having recorded, please follow us on YouTube at the Conker's Corner account. Follow us on Google, follow us on Amazon, follow us on SoundCloud, follow us on Spotify, follow us on whatever platform you can. We're trying to get to 1,000 followers on YouTube. So please, if you're listening to this for the first time, please follow us. Even if you don't listen via YouTube, please follow us on YouTube, and let's get to 1,000 before the end of May, and then we can crack on. Okay. Pete, any other comments?
No. Thank you, everyone. And thanks, Swiss Rash, for that comment you just made. Brilliant.
Okay. I'm going to ask everybody to unmute themselves and come back onto the screen now. Go for it, everybody, and then we can say goodbyes to everybody and we can toast to everybody, and then unmute, put yourself on the screen. And I just want to say a big, big, big thank you to everybody, and everyone can give everybody else a bit of a wave. For some reason, I think there's a power cut other than the computer that Jared's running on battery, because he's sitting in the dark, Jared. So if you can all unmute, please. Michael's gone, I think. Martin 13's run out of lights. Steve's run out of lighting as well.
Michael's back.
Okie doke, ladies and gents. I'm leaving it wide open. We're going to cut now, or in a minute, but I'm going to allow 2
Someone's in
questions.
their bath.
I'm going to allow 2. Pete, stop for a second. I'm going to allow 2 questions from anybody that wants to just shout out 2 questions or make a comment, and then we're going to have to go because it's been running for 2 hours.
Well, I've got one for Wheelie. This is going to stump you, mate. Why is Ireland such a great investment?
Ireland?
Yeah, why is Ireland such a great investment? Its
Ireland,
capital is Dublin.
In the Emerald Isle.
No.
I have no idea.
Taxation.
You're going to have to answer for me.
Its capital is Dublin.
Yeah, okay, I'll give you that one. Quality. Yeah, nice one.
Can I just say to both of you?
Totally got me there.
Okay, sorry, who's speaking? Sorry.
It's me, Steve.
Make it quick, Steve. Come on.
Yeah.
Hi, Steve.
I just want to say, beyond the stocks and shares, I just want to say massive congratulations to both of you on getting to 100. But the additional work you do in the background for lots of other people, lots of charities, it's more bigger than the sum of just you two and those sort of individual parts. So there's a lot more going on in the background than anyone could ever imagine or believe. So a big thank you from those sort of people and users of your abilities. So yeah, massive congratulations and thank you for everything you do for them.
Cheers, Steve.
Brilliant. Thank you ever so much, Steve. Really appreciate that. That's very, 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 very kind of you.
Thanks, mate.
And I want to say thank you to everybody, because I know there's some guys on here that are not in the UK. So Swiss Rash, thank you ever so much for calling in. I'm not sure where James is today, but I know normally he's not around in the UK. So James, thank you ever so much. And I will be buying that bookshelf off you, mate, when I see you next time. I love that bookshelf in the background.
I thought it was in the British Library.
maybe, but thank you guys ever so much for coming on. I'm absolutely thrilled that you could make it. I'm really appreciate your continued support. I'm going to ask you all, when this goes live and is published, to please just comment about it. Please give it a retweet, and let's just build this as far and as wide as we can, because the whole purpose of this podcast is to enable other people to learn. That's all we're trying to do here, to enhance other people's learning. We make other people better investors than we were at the stages that they are now, so they make less mistakes. That's all we're trying to do here. And if we can do that, we can make it a better place for everybody else, because everybody wants to get to a place where they don't have to work for the man, okay, or the woman. Everybody wants to be financially free. So let's help other people get there, okay? Take care. God bless you. I'm going to stop the recording now. Stay here. And I'm going to get some more to drink, and we'll carry on chatting.
Cheers, everyone.
Cheers.
Cheers.
Thank you very much.
Cheers.
Bye. That was the end of
Great
Podcast 100. Boom.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.